The difference between the perspective of a market participant and one that is entity specific, but I've also heard people talk about the difference between an exit price and an entry price. If you're talking about the price to sell an asset or transfer a liability, isn't that really the cost of entering a market?
It's a different concept, and it's one that they struggled with for some time during their deliberations leading up to 157. An entry price is what you pay for something when you acquire it today. So let's say that I buy an asset January 1st, 2000. Well, the price I record in my financial statements is the entry price. That's the price that I had to pay to acquire the item. If I hold that asset, let's say I hold the asset through December 31st, 2009, the value of that asset on December 31st, 2009 is called an exit price. So that amount that they're talking about in ASC Topic 820 is an exit price, meaning if you still are holding the item, you're still holding the asset, what would market participants pay for it at the reporting date, not necessarily what would they have paid for it on the acquisition date.
Now, over the past years, valuation experts have come on this program and told me that the fair value of an asset is based on its highest and best use. What exactly does that mean in this context?
It really means either you use the item with a group of other assets, meaning it's used in synergy with a group of other assets, or it's used by itself. And if the asset would have a higher value with other assets as a group, then that's the valuation that should be used. If it has a higher value being used on its own, then that's the value that should be used when they refer to the term highest and best use. So it's the highest and best use as market participants would use it, meaning in association with other assets or as a separate independent asset on its own. And the values in many cases are different depending upon whether it's used with others or whether it's used on its own.